Symposium and Luncheon. My name is Tim Newman, and I'm honored to serve as co-chair of today's symposium. Today, we gather to celebrate a shared commitment to strengthening our economy, empowering our communities, and building a future full of promise. Whether you have been engaged in this work for many years or are joining us for the first time, your presence here today truly makes a difference. Before we continue, I would like to introduce our club president to make a special presentation to our host sponsor. I invite Rotarian Dr. Dan Heimerman, Chancellor of the University of South Carolina, Aiken, and Kiata D. Priester, President of our Rotary Club here in Aiken, to please join me on the stage.
Thank you.
Thank you. Dr. Heimerman, thank you for your partnership, leadership, and continued support of this symposium in our community. It is now my pleasure to introduce a fellow Rotarian and valued leader in our community, the MC of today's event, Mr. Bill Tucker. Bill is a partner and practicing attorney at Hull Barrett PC here in Aiken, South Carolina. Beyond his professional accomplishments, Bill is deeply involved in our community through Rotary and the Community Foundation for the CSRA. As many of you know, he is famous for having the very best auctioneer voice in Aiken County. Please join me in welcoming my friend and fellow Rotarian, Mr. Bill Tucker.
Thank you.
Have fun.
Thank you. That is not true. It's Tim McClendon is the best auctioneer. He took over the auctioneering duties at the Rotary Club meetings, and he's far superior to mine. So good afternoon, everyone. It's great to see all of you here. I am a proud member of the Rotary Club of Aiken since 1984. So if you do the math, you can figure out pretty quickly that I'm really old. But it's a wonderful opportunity to gather, to network, to celebrate community. And we are delighted that you're here to be a part of that. My challenge for you today is, if you haven't already, I want you to meet and introduce yourself to one new person that you did not know before today. So as we begin our program today, we're going to start, we're blending this in with a traditional Rotary meeting, in which we didn't have on this past Monday. So we're going to start with the traditions that reflect the Rotary's shared values of service, citizenship, and respect. And so with that, I'm going to invite Dr. Frank Sawyer, the head of school at Mead Hall Episcopal School here in Aiken and a member of our Rotary Club, to join me at the podium for the invocation. Frank.
Thank you. Let us pray. Heavenly Father, thank you for gathering us here today. We are grateful for the many hearts and hands committed to service. We give thanks for the opportunity to gather as Rotarians, business leaders, government leaders, and community partners united by a shared commitment to the prosperity and well-being of Aiken County. As we engage in conversations about growth, invocation, and economic opportunity, grant us wisdom and discernment. Help us to see not only what is profitable, but what is purposeful, remembering the Rotary ideal of service above self. Bless the work of those who create jobs, foster entrepreneurship, and invest in the future of this community. May our deliberations be guided by integrity, collaboration, and a genuine desire to serve the common good. We are grateful for this place we call home and for the chance to shape its future together. May our efforts today strengthen our businesses, our relationships, and our shared sense of responsibility to one another. Amen.
Thank you, Frank. I would now ask the Aiken High School ROTC unit to present the colors. if you'll join me in the Pledge of Allegiance to the flag. I pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all. And now Danette Rowe will sing the national anthem for us.
Oh, say, can you see by the dawn's early light what so proudly we hailed at the twilight's last gleaming, whose broad stripes and bright stars through the perilous fight o'er the ramparts we watched were so gallantly streaming, and the rocket's red glare, the bombs bursting in air, gave proof through the night that our flag was still there. Oh, say does that star-spangled banner yet wave o'er the land of the free and the home of the brave.
Thank you. Danette, thank you very, very much. Another talent of Danette's that I did not know about until today. At this time, it's my distinct honor and pleasure to introduce our keynote speaker for today. Tom Barkin is the President and Chief Executive Officer of the Federal Reserve Bank of Richmond. In this role, Tom helps guide our nation's monetary policy and works closely with communities and businesses across the 5th Federal Reserve District. Prior to his role at the Fed, he spent more than 3 decades at McKinsey & Company advising leaders around the world. He brings a unique perspective on our local economy, our national economy, and our global economy, and we're honored to have him join us today to hear his insights and to participate in our panel discussion. He is living in Richmond, but he is a property owner in South Carolina, so he knows about Aiken and he knows about South Carolina. So please join me in giving a warm welcome to Tom Barkin.
Thanks for that kind introduction. It's so great to be back in Aiken. I remember very fondly December of 2020, in the middle of the pandemic, that the Aiken Chamber was the first chamber to actually have a group meeting again. And how excited I was to be here in the theater downtown, and how great it was to be back engaging with folks again. So great to be back here. And so what I thought I'd do today is just spend a little time talking about the economy, mostly national. We'll do some Q&A afterwards for folks who are interested. And maybe I'll just start with the Fed, because some of you know the Fed has a dual mandate from Congress: stable prices and maximum employment. And our job's pretty simple. If either part of the mandate moves too far away from its target, our job is to guide the economy back home. And that's what happened during the pandemic. Inflation spiked, which helped us remember, unfortunately, a lesson we had to relearn from the 70s, which is just how much we hate inflation. Inflation feels unfair. Inflation creates uncertainty. And frankly, it's just exhausting. It's exhausting to negotiate with suppliers or to shop around for better prices. And so, as I hope you would hope, the FOMC did the job that Congress asked us to do. We moved to bring inflation under control. We raised the Fed funds rate over 5 points in 17 months. And the steepness of that hiking cycle made many people worry that addressing high inflation would come at a severe cost to the economy. You may have heard it called the most predicted recession in history. But instead, inflation started falling back toward our 2% target, while the economy and the labor market remained impressively resilient. We seem to be headed back home. But of course, last year was unique. The pace of change was overwhelming. Think the range of geopolitical tensions in places like Ukraine or Gaza or Iran or Venezuela. Think about the transformational possibility of artificial intelligence. Think about government policy changes like tariffs or immigration, the tax bill, deregulation, spending cuts, and the government shutdown. It was frankly just hard to know how all these shifts would play out in real time for demand, for employment, or for inflation. I try to liken it to driving in a dense fog. If you're in a dense fog, you don't want to put your foot on the gas. You don't know what lies around the next curve. If you're in a dense fog, you don't want to put your foot on the brakes. You don't know who's going to crash into you. So if you're in a dense fog, what you do is you pull over and you turn on your hazards. And that's what most businesses told us they spent the year doing. On the side of the road, not cutting back on investment, but not investing further, not hiring, but not firing. And of course, the visibility only worsened further when everyone lost access to government data during the shutdown in the fall. But as we move into 2026, the data is coming back, and it feels like the fog is starting to lift, or perhaps our eyes are just starting to adjust. The road ahead is coming back into focus, and once again, we're seeing an economy that remains remarkably resilient. And I'll give you just a few numbers on that. Third quarter GDP has come in at a very strong 4.4% growth. Consumer spending, which makes up nearly 70% of GDP, remained healthy through the fall. The unemployment rate ticked down in December. It's now at 4.4%. For context, the unemployment rate in this country has only been 4.4% or lower 3 times in our working lifetimes. In the late 90s, in the 2006-07 timeframe, in the late 2010s. And unemployment claims, which are a marker for layoffs, have remained low. So why do we have all this resilience? I just think the underlying dynamics are very healthy. Consumers have jobs, as I said. With inflation now down, real wages are increasing. Asset values keep growing. Corporate earnings remain strong. In circumstances like that, it's just hard to imagine consumers or businesses moving to the sidelines. And at the same time, inflation's come down. PCE inflation now sits at 2.8%, and expectations for near-term inflation have fallen as well, suggesting more progress to come. And businesses tell me the same thing. I've talked to over 75 companies since the start of the year, and they tell me their demand is fine. In fact, fine is the word that's used overwhelmingly in these conversations. Not frothy, not weak, fine. What's going on there? Their customers have learned to live with higher uncertainty. Most firms I talk to are not doing layoffs at scale. Why would they when demand is fine and margins remain solid? Many of those who were just bound and determined last spring to pass on tariffs now announce that their pricing power has been significantly constrained by customer pushback. That's good news for inflation. Also, Pepsi caught the price of Doritos this morning. I was happy to see that. The recent rise in productivity also suggests that these businesses can bear higher input costs without facing as much pressure to raise prices. And the economy is still getting meaningful additional support from government policy. There's significant stimulus in train from tax refunds, reduced withholding, lower gas prices, not to mention the impact of our recent rate reductions over the last year and a half. Deregulatory efforts should support growth as well. At the same time, the focus on slowing net migration suppresses the level of job growth that's needed to keep the unemployment rate steady. And the renewed bipartisan effort on affordability could also be disinflationary in the coming months. So we can better see the road ahead, but if I could echo every family road trip I've ever taken, are we there yet? Not quite. We still have some distance to travel before we get home. So why do I say that? 3 things. First, weather conditions could change. The impact of all these policy changes that I mentioned still remains uncertain. The policy mix itself is volatile, as we've seen over the last month with geopolitics and trade policy. Markets can also be volatile. We've seen that recently as well. The pace and impact of new technologies like AI is still to be seen. And amidst all this uncertainty, you've just got a consumer base that's uneasy. Consumer sentiment measures right now remain historically low. And while we've made a lot of progress on inflation, it still remains above our target. And that's been the case for 5 years now. Now, it'd be easy to blame the one-off effects of tariffs or measurement lags and shelter costs, but I take the sustained miss in inflation seriously. And that's because I believe that today's inflation numbers, regardless of the why, significantly influence tomorrow's inflation. And let me just paint a picture for some of you about what that looks like in practice. So put yourself in a boardroom anywhere in the country, and you'll see a sales team and a finance team debating how aggressively to increase prices, for example, in the context of tariff-driven input costs. If I can stereotype, the sales team doesn't want to pass through those costs. They're worried about lost volume. The finance team doesn't want to eat those costs. They're worried about reduced margins. And so when they're having that debate, today's inflation becomes a key fact in that debate. It helps finance raise prices when inflation's high and helps sales price cautiously when it's not. With inflation still above our target, I suspect the finance teams have been doing pretty well recently, at least based on what I saw in my streaming services bill last month. Finally, the road home's a narrow one. The strength in demand seems focused in 2 places: the AI ecosystem and those people who sell to wealthy customers. And I'll just make the point that those 2 segments are connected. Imagine, if you will, an easing in the AI frenzy. That could hit business investment. That could also hit the stock market, which in turn could hit consumption by the wealthy should they see their net worth decline. Job growth has been narrow as well. A fact I just picked up is that 97% of net private sector job creation in 2025 was in one sector: healthcare and social services. So what happens if the healthcare sector pulls back in the context of elevated uncertainty about their reimbursement models? What sectors would pick up the hiring slack? I will say, in my conversations, as good as everybody feels about demand, it's really hard to find people who are leaning in on hiring. Now, hiring's been low, but that hasn't translated to rising unemployment, as I suggested earlier, because the growth in labor supply has shrunk at about the same pace as the growth in labor demand. But slow job growth isn't a comfortable place to be. I'll close by talking about monetary policy. What does all this mean for interest rates? As I said earlier, we raised rates significantly 3 years ago in an effort to bring inflation under control. As the inflation rate has fallen, we've been bringing rates back down toward normal levels, reducing the Fed funds rate 175 basis points over the last year and a half. I think of these cuts as taking out some insurance to support the labor market as we work to complete the last mile of bringing inflation back to target. And I'll just say, so far, so good. But we know things change, and as they do, we're ready and able to respond as we need to. And with that, I think we're going to a panel and some questions.
Thank you, Tom. We are joined on the podium now by Chris Vereen's, the CEO of Security Federal Bank, and Dr. Johnny Green, the CEO of the Savannah River National Laboratory. 2 great choices. Our little living room here is compliments of Nandina Home Design. If you like the chairs you see here, you can probably get it in the gently used section of Nandina following today's program. So I'm going to join them over here, and we're going to have a little Q&A and then some more Q&A. So give me just a minute.
Tom, is this microphone working?
There you go. You can tell we don't do this every day. There you go. Okay. All right, Chris is going to lead us off with the first question to Tom. We met last night to sort of get acquainted, and it was a great opportunity, and we had a great conversation at dinner, and I told my wife when I got home it was like having a senior colloquium. I should have gotten college credit because it was a great, wide-ranging discussion about a lot of different topics. So hopefully we can recreate some of that today.
Tom, at our bank, we see a lot of data at the micro level, housing starts, loan demand. You have in your position an enormous amount of macro data coming at you. From your vantage point, how do you sift through that, and can you point to a few key economic indicators that mean the most to you and that may signal where the U.S. economy may be headed?
Okay, thanks. And again, I'm looking forward to this conversation. So you're right. There's a ton of data that comes through. It's in the news every day. I guess I'll just make the point that the data that comes through gets revised 3 times, and it comes in a month and a half late. And so it's helpful and confirmatory in what you see in the economy, but what I learn about the economy is what I learn here. When I'm talking to small businesses about their hiring and their firing and their pricing and tariffs and all of that kind of stuff. And I use the data and the information I get on the ground to validate each other. That's how I think about it big picture. In terms of what I'm looking at right now, as I said in my talk, we're in this odd place. I mean, the unemployment rate is at a very low level historically, and it's relatively steady, and we're not adding any jobs in the economy. And the reason the math of that works is that the labor supply growth is coming off as well. And that's just not a very comfortable place to be. And when you're in a low hiring, low firing, low growth environment, you're always attentive to this question of, is demand going to stay so healthy that businesses are going to need to meet their customers where they are and start adding staff? Or are you going to get one of those waves of layoffs that happen sometimes when people get pessimistic? And so I'm looking very closely at the labor data. We get initial unemployment claims every week. That's the best indicator of what's happening in terms of firing. I'm looking at, everybody I talk to, I ask, are they hiring? And I'm looking for people leaning in. I really think the jobs market's going to be the story of the next year.
There's been a lot of talk, as you know, about where short-term interest rates should be as set by the Fed.
I hadn't heard any of that.
I didn't think so. Where do you fall on that question? Do you think we're where we need to be? And also, do you believe there's such thing as a neutral rate, and where should that be?
So you're asking, do I think that where we are in rates today is the right place to be? Oh, yeah, absolutely. We're good. So here's how to think about it, which is 75% of the time, our job is really easy. If inflation is high and unemployment is low, raise rates. That was 2022. If unemployment's low, if unemployment's high and inflation's low, then lower rates. That was 2020. If unemployment's low and inflation's low, go on CNBC and say some positive things about what a great job you're doing. And then, but we're in a different box. Unemployment has been ticking up and inflation's above our target. That's the hard box, right? And so there's no easy design of what to do when you're in the hard box. You just kind of feel your way there. And so, like I said, a year and a half ago, we were 175 basis points higher than we are today. That felt like it was very focused on inflation and not at all focused on the job market. So we've come off of that. So now at 3.5% roughly, we think we're in a place where we're focused on the labor market and focused on inflation. But nobody knows whether that's the right landing spot or if it's a little lower or a little higher. You just have to feel your way as you see how demand and the economy respond.
Wealth inequality in this country has hit record levels. And some people blame the Fed, actually, for the lower rates over the years to cause that. But what are the consequences of this trend? And are there any policy prescriptions that are not controversial or zero-sum that the country can take?
So wealth inequality, it gets a lot of attention. I should probably start with what I think is the bigger part of the conversation, which is poverty. I mean, the fact that there are a lot of people at the bottom who are making so little, and you can see at food banks that the demand has gone up significantly. There are people not in the workforce that really could and should be in the workforce, could better support their families if they were. So we could talk a lot about inequality. I guess I prefer to start by talking about poverty, and making sure we're doing what we can as a society to help people lift themselves up over time. So that's the first thing. In terms of policy on that, the best thing I've seen is this Raj Shetty work, which makes the point that if you want to have social mobility, the key element is, do you as a young person live in communities where you can see people with different careers, and you can have access to exposure to a lawyer, a doctor, a banker, a business person, and see that for yourself. I just think that's a very powerful thought, and it resonates with what I grew up with in a public high school in Tampa. But I just think it's really, that's the poverty part. Inequality is a much different issue. You could solve inequality very quickly. The Fed can't do it, but you could do it with every combination of fiscal spending or taxing. That would not be popular, probably with anybody. And so I think the challenge you get into with inequality is more long-term, and it's just more, I'll call it political. How do societies, survive when it doesn't feel like people have equal shots? And I think that's the challenge with inequality. It's not an economic challenge per se. You can come up with analogs. It's a political challenge.
Economists point to our aging workforce and slower population growth as being a problem for the future economic growth in this country. We've had a lot of talk about immigration, but what impact does lower immigration have on the workforce and productivity?
Well, maybe I'll go big picture on this for a second. Most economic development is focused on attracting jobs. And the reason it's focused on attracting jobs is, in the country, we had a lot more workers than we had jobs. And the reason we had a lot more workers is that the workforce was growing significantly. And that was the baby boomers fully participating in the workforce. That was women more fully participating in the workforce. That was people living longer and working longer and being healthier and participating in the workforce. That was the growth of access to offshore talent. So you had other places to put it. And so we had lots of workers and not a lot of jobs. And that's why economic development was all about jobs. And I should say South Carolina's done a brilliant job on that over the years. If you go to today, the numbers are changing quite significantly. Fertility's down. You guys have heard that. That's going to be an issue for native-born population growth. The baby boomers are aging. I'm not, but some of them are. And that's another set of problems, and we're seeing participation really drop for people 65 and up. Net migration in this country has gone way down and looks like it's going to stay down. So that's another lever. And so we're headed toward a world where we're not going to have as many workers as we thought we were going to have. And so we got to be thinking about the workers too. Again, I should say, South Carolina's done a great job on this as well, technical schools and all that stuff. But that's the lever today, is more workers and getting more workers into the workforce. And the places and communities that can do that, I think will thrive. We will have a mismatch issue of sorts. I mean, there's lots of debate about how far AI will or won't go, but it's not hard to imagine a bunch of entry-level jobs today, held by people who will be laid off, and then the redeployment, the jobs that are going to grow are the jobs like I was talking about earlier, healthcare, social services, taking care of my mom. I mean, those are really hard jobs, and it's not clear that everybody wants to do them. And so that may be the bigger issue, is not a lot of job growth, and the jobs that we've got aren't matched to the desires of the people who are out there.
If I go back to interest rates just for a minute, you mentioned that the Fed has lowered rates 1.75%, but the longer-term rates aren't coming down. They actually may be going up. What's going on with that?
So I'm not trying to run away from mortgage questions, because everyone thinks we control your mortgage rate, but we don't. We control the short-term rate, the rate that banks lend each other to overnight. Your mortgages are determined by the 30-year rate or the 10-year rate, depending on what duration your mortgage is. And you're right, as we've taken short-term rates down, those rates have stayed steady or even drifted up a little bit. And I don't have a better explanation other than it's the supply and demand of longer-term treasuries. The supply of longer-term treasuries is up a bunch. That's the government deficit, right? The government is funding itself by issuing ever more treasuries, and that means there's a lot more supply in the market, and it takes higher yields to sell that. And on the demand side, I'm not sure that the demand has come off for treasuries, but I would say that I think it's 30% of U.S. treasuries are owned by foreign owners. Maybe there is some amount of movement away from U.S. assets, but I think the bigger issue is that 5 years ago, all of the banks in these foreign countries had 0 or negative interest rates. And so if you're an investor with some savings and you're in, say, Japan, and you have a choice, do I put that money in the bank and pay money to keep it in the bank, or do I invest it in some place where I'm taking some currency risk, but at least I get some yield? I think a lot of people are making that choice. These days, I think a lot of them are taking money out of our markets and putting back in their markets, which is sensible because their markets are now paying higher positive interest rates again. And so the supply side is up. I think the demand side is off. That means the yield goes up.
Okay, I think we're going to change our focus over to Johnny. So, Johnny, you have some questions for Tom?
I have a few. Thank you, Bill. So, Tom, from my perspective as a National Laboratory Director, we see every day how federal research and development investments drive innovation, attract talent, and support long-term economic growth. So in your opinion, how do sustained R&D investments influence productivity, economic resilience, and national competitiveness over time?
Well, I think there's no doubt that productivity is driven out of short-term investments and long-term investments. And short-term investments look like, a new staffing model or a machine that you put into your factory. But the long-term investments are fascinating, and they're huge examples of things you invest in today that pay out 5, 10, 15, 20 years from now. Famously, the NASA program, which didn't just invent Tang, but also invented GPS and a whole bunch of other stuff that's been highly valuable. It's hard, of course, to, not all of these investments pay out, and so you have to have a portfolio of investments just like a venture firm. But I think, it's very hard to do and to fund, but you've got to invest in tomorrow at the same time as you're investing in today.
So a follow-up question related to that. So how do you view the role of national laboratories and other anchor institutions in stabilizing local economies, attracting private investment, and also in creating high-skilled job clusters?
Well, I just say one of the things, every week I do, a couple things like this in some new town in my district, which goes from South Carolina through Maryland and West Virginia. And, when I go to communities, they're dying for some asset that they can sell. Sell to employers, sell to employees. Some of them have natural beauty, that's great. Some of them have universities, that's great. But the existence of a research center is a huge asset to sell. And a lot of them really don't have assets to sell. So I think it's a great asset to sell. But you've got to build around it, as you're doing, as I saw this morning driving in. You got to build around it. But I think the notion that you've got something that can attract talent and capital, you got to market that all day.
Okay, hope my marketing team heard that. Okay, we got some work to do. Okay, so what economic indicators suggest that a region is successfully leveraging a research institution that is an anchor?
What economic indicators?
Yeah, show that if you're using it the right way and it's an anchor and you're really getting the marketing and the visibility, what economic indicators would then follow?
Yeah, I think that's a little, I come back to economic developments about attracting workers and attracting jobs and getting in the positive, synergy there. And so if you think of places that seem to make that work, population growth, workforce growth is a huge indicator that you're having some success. Obviously, that's true here. I think attraction of additional affiliated businesses, a lot of these have ecosystems in the same way that Greenville and Spartanburg have this whole ecosystem of firms that serve BMW and Michelin and those guys. To have that kind of ecosystem here or another place with a research lab, that's your jobs indicator. But they got to work together.
So something that we often face in the research space is, how do you translate innovation from the lab into the marketplace? And so from your vantage point, what's your opinion on how to assess the economic impact of technology transfer, commercialization, and spin-off companies?
Well, I don't think there's a ton of work that's actually done on that. I really was taken, I read this book, Abundance by Ezra Klein. Its basic theory is that a huge part of the answer to the economy is the supply side. Now I just saved you $14.99. But one of his theories is that we do lots of primary investment in research, but we don't really manage it as a portfolio and track the impact over time. And I think that makes tons of sense. Not that every investment's got to pay out the next year, but the notion of saying look, I've got an investment. I've got a portfolio of things. Some will be near-term successful, some long-term successful, and I am actually going to hold myself or my agency accountable for those investments. I think that makes a ton of sense, but I don't think it's really done very much today. I think the grant is written, the grant is funded, and people go and invest, and no one really owns the. If you were at a company and you had an R&D department that was investing in X, you would spend all your time thinking about how to bring it to market. I think it's more thousand flowers bloom on the bring it to market, unfortunately.
I agree with that perspective. That's been my observation as well. It's not an easy thing to track. So what conditions or policies best support turning research breakthroughs into sustainable economic activity, in your opinion?
Well, we have some real policymakers here. I'll let them, focus on that stuff. I'll just say I've really admired what I've heard about what y'all have done here, and just the employment that's built out of the labs that you guys have had. And even in 5 years, it feels to me like it's changed.
Now, something that's also going on, you mentioned, we're in this international space, so other countries are intentionally co-locating research, higher education, and advanced manufacturing to compete globally. From your perspective, how should the United States think about this global race for innovation, and what economic risks do we face if we fall behind?
I think I'm going to pass on talking about it. I'll say pass again, because I think our job is interest rates, monetary policy, banking. We're not in the fiscal policy thing. There's some real policymakers here. We'll let them give their opinions on it.
Fair enough. So hopefully this one hits. Okay, from a macroeconomic standpoint, what conditions allow regional innovation and clusters to thrive, and what role do national laboratories and other research centers play in sustaining those clusters over time?
Next question. No, this is. Good on the national labs. I don't have more to answer on the national labs. I don't think.
Okay, and my last one is. Let's see if this one hits. Okay, so how should communities and their stakeholders think about intentionally building these clusters over the next decade, these research clusters, these innovation ecosystem?
Again, it's out of my expertise land. I'm sorry. I've sort of answered what I know about that.
No problem.
You're striking out.
Well, yeah, that was 4 strikes, yeah.
Well, it's 500. So, Tom, I've got a question for you. So what is the one trend that you're particularly optimistic about, and one trend that you are very concerned about over the next 5 years?
Yeah, so I'm actually quite optimistic on productivity. A bunch of folks got caught short workers 3 years ago, and that encouraged them to invest in automation, in new processes, in new models that help drive higher productivity outcomes. We're seeing that today. Then you've got technology. Everywhere I go, whether it's robots or AI, people are investing in new ways of doing business. And I think, we had a very strong productivity period during the 90s. That kind of came off in the mid-2005 range to 2015, 2020 range. Kind of feels like we're on the brink of that. Deregulation could be part of that as well. This focus on supply and supply growth, which might unlock some barriers to building some stuff and doing some things. So I'm actually quite optimistic on productivity. I think one of the challenges we're going to have, as I said earlier, is a lot of demand growth without a lot of workforce growth isn't going to feel as good, but it will help us grow. And if you don't have workforce growth, you need productivity for the economy to keep growing. So I think that's a real thing, and especially if the workforce stays short over the next 10 or 15 years, as I'm suggesting, we're gonna have it. We're gonna need it. A thing to watch for. So it's not lost on me that in the last 2 or 3 years we've had whole industries brought down by technological outages. I'm not even talking about my pipes freezing over the weekend, which happened at Polly's. But I'm talking about the auto dealers that were brought down a year and a half ago. A company called CDM was a provider, and it had a problem. The healthcare billers were brought down about a year and a half ago. You may remember CrowdStrike, which brought down the airlines about a year ago. I think as the world and as we've gotten more technologically enabled, I think we're now hugely more technologically vulnerable. And we saw that in Nashville after the hurricane last year, I guess it was, where the electricity was gone and people couldn't use ATMs. So, and you couldn't use your credit card. So you sort of think, well, if I need money, I'll go get cash out of the ATM or I'll get my credit card. But the banks weren't open. And so I just think we're technologically enabled in awesome ways, but we're technologically vulnerable in a way that is not really sort of hit home yet. But I worry about that.
So a wild card question for you. Tell us about Kevin Warsh.
I've met him a few times. I don't know him. I'm told he's going to be the new chair, and so we're looking forward to working with him. I think the job of being the Fed chair, I like to describe it, if you like log flumes, and I do, you'll remember that as you go through a log flume, at the very end, there's a slow climb up to the top, and then the flume goes full speed down into a pond of water, and the water comes up and it splashes the guy in front. Yeah, that's the chairman of the Federal Reserve. The rest of us were just in the back with our hands in the air, but God bless him, he's taken a very tough job.
So you might tell the audience, because of your presidency of the Richmond Bank, how that all works on the Board of Governors. It's how many people total, and it's the 12 districts and...
Yeah, so there are 19 people on the FOMC, which decides on interest rates. 7 of them are appointed by the president and confirmed by the Senate, and Kevin would be one of those. Jay Powell is one of those. And then 12 are presidents like me who are nominated by local business boards and then confirmed by the Board of Governors. And so my last 2 interviews were with Janet Yellen and Jay Powell, which was kind of intimidating. We all participate in the meeting, and then 12 of the 19 vote. The vote rotates. But it doesn't, we haven't had a 1-vote margin since the 80s. But you're a full participant as you go through the process. And it's a public-private partnership that's national, local. The guys we're the 3rd central bank of the U.S. The first was Alexander Hamilton. That blew up in 1810. The second was a guy named Nicholas Biddle. That blew up in the Jackson administration in 1832. And then we didn't have a central bank for 80 years. And during that period, we had the Panic of 1937, and the one in 1957, and the one in 1873, and the one in 1893, and then famously the one in 1907, because there was no backstop for the banking system. And so in 1913, they decided to create the 3rd central bank of the U.S., which is the Fed, as the backstop for the banking system. And at the time, they really litigated this question of, do we want all the decisions taken in Washington or not? And they came up with this public-private, national, local strategy explicitly because they didn't want to centralize all the decisions with people in Washington who were living in some ivory tower and not really out in their communities. And so I see a big part of my job as being on the ground in the communities, trying to understand local conditions and what's actually happening and bringing that to Washington, where I also meet the guys who spend all their time in Washington and have their own views. And we debate it out. Sometimes I win, sometimes I lose.
Very good. Well, I think it's coming to that time in the program where we would accept some questions from the audience. And I think I saw Will Williams' hand over there. Hey, he's been waving at me for 20 minutes at least. No. Will, you got a question?
Absolutely.
Jennifer's coming with a mic for you. We want everybody to hear this question.
Okay. So what policies and workforce strategies and other types of infrastructure investments should we be looking at to maintain this pace that we've had here?
Well, so I first of all, I'd agree. We do all this analysis for all of our states. South Carolina always ends up on top, and that's the combination of job growth and workforce growth and how that works together. I do think that the opportunity for South Carolina is workforce participation. The participation rates are lower than they are in other states. Some of that is retirees, but that's not all retirees. And if you think about what it takes to get people in off the sidelines, education is a huge part of it, K to 12, getting people ready, hard skills, but also soft skills, preparedness for the workforce, training, which I think South Carolina's done a ton of investment on, and how to get people, skilled up and matched to the jobs that are there. But, moving people in is great. I'll also say, and I've even seen this in a couple counties here, sometimes if you build too much housing, people start to push back. You know, Pickens County, for example, has had a moratorium, if I understand it correctly. And so, you know, moving people in is a great strategy till the people who are in decide they don't want more people, and that's a challenge. And then, so I think this notion of getting people off the sidelines, that's the additive. It's not instead of, it's an additive that I think would get more people working, which then gets more companies here, which gets more opportunities and more growth.
Thank you, Will. Chuck, Admiral Chuck Munns. And then the one back, I saw a hand back there, yeah.
Thank you for being here, and I agree with Bill. Dan Heimerman should give us credit for an economic course here today. I'd like to ask you about restricted trade. So there's an inflection point. You talked about many, but certainly trade. It seems to be an inflection point. Last 20 years have been pretty great. Now the Chinese Belt and Road Initiative is putting debt on the third world. The EU is putting restrictions on content of things that they sell or buy or services, sanctions, and who knows where tariffs are going. So what would you tell the businesses here they should expect over the next 20 years in a regime of more restricted trade?
So I'd actually put it a little differently, which is, I think with 2020 hindsight, the 30 years after the Berlin Wall fell, were a period of uncommon stability in the business environment of this country. You know, there were no questions in geopolitics who was in charge and what the terms were. The world was heading unequivocally toward free trade, and you know, therefore you could make investments in India or China or wherever to help you know, do your stuff. The inflation rate was stable at 2%, really didn't move for 30 years. GDP grew, you know, we had a financial crisis and we had 9/11, but really 2 recessions in 30 years is pretty impressive on a historic basis. And I think with that stability, people got really comfortable expecting a set of, and interest rates were low and all that stuff. It just feels to me like we're going into a period of increased policy volatility. And, you know, that's true on the national front, you know, the moves from administration to administration. Imagine somebody who was building an offshore wind farm and, you know, how they were subsidized and now they're out. I mean, you know, I don't know what the right answer is, but the volatility is tough for business investment. Regulation would be another version of that. I think geopolitics certainly doesn't feel like the next 30 years are going to feel like the last 30 years. And so trade's part of that. And so I just think this is one of those where if you're a business, you got to wake up and say, I can't take most anything for granted. I've got to build in flexibility. And so, you know, Germany somehow decided to source all of its natural gas from Russia. Why did that make sense? I mean, somebody somewhere thought that made sense. And I think they had a view that Russia would be a stable partner for the next generation and beyond. Well, that wasn't a good business decision. And if you put all your supply in China 10 or 15 years ago, you now look at it, you go, why did I make that decision? You know, how could I possibly assume that there couldn't be a fracture in the relationship at some point in time? And so I just think this notion of how do you manage, how do you force yourself to assume a more volatile environment? And it's a cousin of the technological thing that I talked about before, because some of you have multi-factor authentication. If your multi-factor authentication is just with one provider, then are you set up if that provider has an outage? Then no one can get in anything. And you got to think about this volatility as a business and how you're going to configure yourself so that you can recover. That's the big point. You got to be able to recover. If you're in just China, you got to be able to ready to move to Vietnam or somewhere else, or you're not going to be in a good place if the tariffs go to 100%. That's the kind of thing.
Jennifer, there's a gentleman back here with his hand up. If you can take a mic to him. Raise your hand right there. There you go. Table 32.
Thank you. First of all, I just want to thank you for the information that you shared with us thus far. And my question is that what effect would the market have if you all just kept the interest rates at 0 and not raised them at all?
Well, so we had rates at zero in March of 2020, and the market went down a lot. And we had rates at zero in May of 2020, and the market went up a ton. So I don't think we're not the only driver of the market. There's lots of stuff that drives the market, largely driven by earnings expectations. I think it's a fair question what happens to the economy as opposed to the market if you have no cost of money. And I think the answer is you get lots of overinvestment in things that don't pay out. And I think the risk a lot of people worry about is that you'd have inflation spike because you'd have demand well in excess of supply and the price of things would go up, and nobody likes inflation. And so I think if we were to move rates to zero today, I think the thing people would worry about would be nobody likes inflation, as I said earlier. Would that allow inflation to spiral?
Phil, you had a question? You can borrow my mic.
Phil Wall with Security Federal. Hope I haven't used up our questioning with our CEO having some great questions. But my question is about the U.S. dollar. So I have this question for you. How does dollar strength or weakness transmit differently through local economies, particularly exporters, manufacturers, and even community banks? What indicators do you watch most closely, and what are you concerned about?
Well, so the overall thing I'll say about the dollar, it's gotten a lot of attention lately, but the dollar today is in the range where it's been for the last 20 years. We're not out of the range. And so we have a floating currency. Sometimes it floats up, sometimes it floats down. Some of that is because of our interest rates versus other people's interest rates, or the strength of our economy versus other people's economies. But it floats around, and it's not out of the range. When the dollar is stronger, that makes imports cheaper, so less inflationary, but it makes exports more expensive, so less manufacturing happens in the U.S. The flip is true on the other side. If the dollar is weaker, then it's a little more inflationary. Goods from overseas cost more, but our goods are more cheap in Europe or other places, and so we export more. And so that's the trade-off. It's between inflation and, I'll call it, employment.
Got one last question, and we're going to have to move on.
Lieutenant Governor.
Oh, I'm sorry.
Had one.
Governor Evatt.
Well, first of all, thank you so much. Very informative. Something you were talking about Germany. I was in Germany a few years ago on an economic development mission, and because energy was so unstable, they showed their first decline in GDP. So with the Trump administration and their focus on energy and their focus on getting rid of regulation so that energy can be dispatched so much better, does that give you a positive vibe and a positive feeling about future GDP here in our country? And with the onshoring, being a strong energy producer nationally, attracting business, what does that look like? You were asking for positive and negatives. How does that rank for you on the positive side?
Well, so energy is a huge issue, I think, over the next 5 or 10 years. And, underlying this whole issue is this investment in AI that's being made across our economy, which comes with a huge increase in energy needs. And the problem is, like all these investment decisions that have to be made for 5 or 10 years from now, the AI people think we're going to need this much capacity. And each unit of capacity will take this much energy. And so they go to the utilities and they say, we need you to produce this much capacity using this much energy. And if you could have it 3 years from now, that's great. And of course, the utilities don't move that quickly, and the forecast isn't that clean. And so it's really hard to meet a future forecast like that. I mean, so we don't know whether we're going to produce the right amount of energy or too much or too little. But I'll make a bet right now we're not going to produce exactly the right amount of energy. I think there's no way to meet that forecast. And so if we're in a world, as many people think, that we're going to be short energy, short electricity to meet these needs, then we got to be looking hard at all the various sources of energy. And if we can use all these sources of energy to provide enough electricity, we'll be advantaged versus the rest of the world, and that'll help us grow GDP. And if the demand is here and we're not supplying it, brownouts, but I mean, that's a whole nother problem. That's absolutely limited to GDP. So I do think the investments in energy that we're making and that we're going to need to make are going to be critical. I'd say the watch out is we're trying to meet a moving target in terms of demand, and I'm really quite nervous about anybody's ability to forecast what that target is.
I promised the lady back here. You want a mic? There we go. Got a mic.
My name is Donna Wesby, and I want to first of all thank the Rotary Club for sponsoring this opportunity. You mentioned a very important word earlier, and that was poverty. And from where I sit, ever since the pandemic, the gap between the haves and the have-nots has gotten significantly larger, which poses an issue for our local communities with those who either perhaps did not get a good education, or even senior citizens who can't necessarily keep up with this AI focus. And what we're seeing is that there is a significant need for communities to see the need to invest in that particular population. From an economic standpoint, what is the impact on communities who do something to assist those individuals, those have-nots, or the impact on those who do not from an economic standpoint? Because these problems are very real, and from the nonprofit arena where I sit, they're growing every day.
Well, the way you phrase the question is there an impact if they try to help? And of course, some help better than others, and some do the right things or not. And so maybe I'll answer a little bit differently, which is that there's no question, as I suggested earlier, that economies do better if you have more people participating in them. You have more people spending, consumer spending 70% of GDP. You have more people working. I've said we're going to be short workers. And so I think it's an unequivocal good to get a broader set of the community more engaged in the economy of that community. And then, of course, there are very real different strategies for how to do that, which I can't really judge. But I think we're going to be in a place where we're going to have to work on that stuff. Because as I said, workforce growth in this country, because of fertility, which doesn't look like it's changing, is just not going to grow in the way that it has. And if we want to grow the economy, we've got to get more people involved in the workforce.
Thank you. With that, I'm going to call time. Oh, sorry, one more. Table 31. What's that? Helen? Okay.
Thank you. Thank you. I'm Diane Hardy. Thank you for being here today. I have a 30-year-old son who got caught up in the layoffs of a Big Four firm. He has his CFA, his CPA. He was not at all worried about finding a job. 8 months later, he's still out of work. A lot of that's because of the AI. What career sectors are you think are going to be most impacted by AI? It took him all those years to get his CFA, and now they're saying AI can do that for us. So it's not carrying the, after all his work, it's not benefiting him like he thought it would.
Well, I'm sorry to hear about him. This is happening in a lot of places, and the unemployment rate for young people has spiked up to levels that look like recessionary levels at a time where the unemployment rate for older people, I'm including myself in that, is actually quite low. And so he's part of a cohort that's had this issue. I really think the biggest issue is that in the uncertainty that we've seen over the last year, with people trying to drive more productivity, people just aren't hiring. And it's not that the folks who are not getting hired don't have the skills. It's just that the places that would hire them don't have the appetite, if you see what I mean. And you can see how it goes. Hey, look, we got to hit margins for the next quarter. Let's just have a hiring freeze. Let's see what AI can do for us. It's not that AI is necessarily doing all this stuff. It's just let's see what AI can do for us. And that's definitely having its effect. I personally believe it's a short-term effect. And he hasn't asked me, but if I gave him one piece of advice, it is who's more likely to be a superb manipulator of AI over the next 20 years, him or me? And the answer is him, obviously. And I think if he's going to invest in anything, it is how to be a master of using AI. I was with Accenture a couple weeks ago. They're one of the firms, they told me, that had cut back. They're leaning back into hiring again because they've said the skill they need is people who can manage AI. And I think that is, a sharp young guy, that's the person you want to do that. The companies are going to wake up over the next year to that need and that job. And that's, I think, where the opportunities are going to be. It's not outside of AI, it's leveraging it. And again, many of us are not going to be facile at being the people. I think the young people are the people who are going to be able to do it.
We promised Ellen Luton that we'd give her the last. Sorry, Ellen. This is Ellen Luton, CEO of the United Way.
I think you saw me over here.
I apologize.
So I also have a nonprofit question for you. You were mentioning the FOMC's structure of having kind of an on-the-ground approach. Nonprofits in the community tend to experience the economic stress before it becomes a data point for traditional data. How do you use the nonprofit information or that on-the-ground approach to assess the economic climate?
So the chairman of my board is the chair of the Annie Casey Foundation in Baltimore. I've got on each of our boards a set of nonprofit people who bring us insights from their experience. We've also got a community development team that does outreach alongside our business outreach team. And so just inside baseball, before every FOMC meeting, I do an hour-long meeting with my outreach team to talk about what they're hearing from businesses in terms of prices and hiring and the like. I do the same session with my community outreach team to say, what are you hearing from the food banks, for example? I got a briefing on that a couple weeks ago. I mentioned it earlier. Demand's up 20 or 30% across the country. Why is that, when you could say real wages are up and who's the population? So we're doing our best to try to access that through our community outreach. And I find it incredibly helpful. The challenge we've got is that interest rates are a blunt instrument. They go up or they go down. They help everybody or they help nobody. And they don't differentiate among sectors. And so you can't really use interest rates to solve distributional issues, but it is helpful to know kind of where the lines right now, and that's what we try to do.
Tom, Chris, Johnny, thank you so much for your words and insights. So my question to the audience is, did you enjoy this? Would you like to see it done next year? Would you like to invite Tom back for an encore performance? Well, this has been wonderful. This has not happened without a whole lot of time and effort, and the driving force behind it are Tim and Kiata. And at this time, I want Kiata to come to the stage. Come on. Ladies and gentlemen, Kiata Priester, our current Rotary Club of Aiken president.
Well, John, where's my script? All right. Bill, thank you so much. Thank you to our panelists and also to Tom for being with us today. And we have a small token that we'd like to present all of you with. And I'd like to first ask Bill to come forward. Ladies and gentlemen, y'all please give another round of applause to our MC, the man, the myth, the legend himself, Mr. Bill Tucker. Bill is talking about this cannot be done without leadership. Well, he is one of the driving forces behind this room being packed today. So, Bill, thank you for allowing us to use your influence, your name recognition, and who you are to this community. And on behalf of the Rotary Club of Aiken, we'd like to present you with a small token.
Thank you. Oh, pictures.
for you. All right, so I also want to extend a heartfelt thank you to our fire chat participants. Dr. Johnny Green of Savannah River Nuclear Lab. Let me get that right National Laboratory before he gets me, right, Dr. Green? As well as Chris Vereen's from Security Federal Bank. We'd like to say thank you for your support and participation, and we have a small token for you both. We have another one. All right. Thank you both. Thank you, Chris. Thank you so much. Thank you, Dr. Green. Thank you. And Mr. Barkin, if you would join us also, we have a small token for you that is not valued at no more than $5 that I think you can have. So we're safe.
Yes, thank you.
And let's look that way. Thank you so much. Y'all, please give a round of applause for our Aiken High NRTC. Thank you all so much. Okay. Now, so I can get you all back to your places of work, let me share with you a few comments. We all know, just as Bill Tucker stated, that an event like this does take quite a bit of planning and time. And I first of all want to say thank you to the leadership at Aiken Electric Cooperative for allowing me the time to do this. So my table is here over number 13, and I'd like for them to stand. And I'd like to say thank you for allowing me the opportunity to lead the Rotary Club of Aiken as the president and to commit as much time as I have towards this effort. So thank you for that. I also want to say thank you to our co-chairs. This symposium would not have been possible without the efforts and dedication and leadership of Mr. Tim Newman, who is our treasurer of the Rotary Club of Aiken, but he also co-chairs the fundraising committee with me, and also our president nominee, who is Sharon Rogers, and she's sitting all the way in the back, and all she's gonna do is wave. If I ask her to come forward, she really will get me. So Sharon, just wave. She's behaving, she's coming forward. But I'm going to get in trouble after this. I do know that. I'd like to ask Tim and Sharon if they both would join me on the stage at this time. Oh, he's here, the gentle giant. As we come to a close, as I've stated, Tim, I want to say thank you for all of your hard work, your leadership, and your commitment to this event. It would not have been possible without you, so thank you. Let's move forward and let's get a picture. Sharon, thank you.
Darling.
Thank you for your leadership. Thank you for your commitment. Thank you for standing by my side always. and pushing me. And this really wouldn't have been possible without you. So thank you. And I know you don't want to be up here, but thank you.
Thank you, sweetie.
All right.
Oh, my goodness.
And let's look here for a picture, please. Okay. All right. I do want to acknowledge that we have several dignitaries with us today. We are honored to have the Lieutenant Governor, Ms. Pam Yvette, with us. Please stand. And we're also honored to have the Attorney General, Alan Wilson, be with us today. Thank you both for your service. I'd like to also ask all of the elected officials that we have with us today, if you would please stand to be recognized. All elected officials. We have the mayor of North Augusta who is with us, as well as representatives from the mayor's office in Augusta and Aiken. So thank you all so much for being with us today. All right, I think we're now down to the part where we end our meeting. I'd like to ask all Rotarians that are in the room if they would please stand at this moment. Rotarians, thank you so much for being with us today, for serving, and who lead with service above self every day. I appreciate your efforts, and at this time, I'd like to ask Rotarians if you would help me with the four-way test so that we can conclude our meeting. Of the things we think, say, or do. First, second, third, and fourth. This meeting is adjourned.